Welcome back. You're watching Stock Picks now. South Africans are heading to the polls on the 29th of May. After a whole build-up to the elections, in today's segment, we look into stocks that are set to boom in the election period, while also unpacking the risks and rewards of marked-down SA Inc. stocks. Joining us for the analysis is Marc Hasenfuss, the editor for Financial Mail, and Peter Armitage from Anchor Capital. Good afternoon to you both.
Hi there. Good afternoon.
All right, we are 2 weeks exactly away from the polls, so we thought that we'd take a step back and just maybe look at, maybe firstly reflecting, and I'll ask you both on how markets have taken stock of the election, and not only here at home, right, all over the world elections. The US are heading into one in November. That's also bound to drive market sentiments as well as stocks. Peter, we'll start with you.
So I think the SA market is the market and money is not political. It just looks at economic outcomes and economic growth. And I think the fear of the ANC having to link up with people with anti-market kind of policies is the fear. I think as it's in the recent past, it looks like more and more chance of the ANC getting closer to 50 than 40. And you've seen the market re-rate a little bit in the SA Inc. space. You know, when you say the market, half of the market's got nothing to do with this election issue. The SA incorporated half is what we're referring to. And obviously the currency has strengthened. Currency has gone from 1930 to 1830. So that in fact has been bad for the non-SA market.
Mark, keen to get your thoughts here?
Yeah, look, I think I agree with Peter. I think in the last maybe the last 2 weeks, there's been more like a reality check about it. Might not be such a disastrous outcome in the election. Who can say? I mean, you've got to go to the polls and the results will come out, but there's still a degree of trepidation. The SA Inc. stocks are still very, very cheap. No one's rushing in and buying them. But yeah, I mean, it is a watch and wait scenario. I think investors in South Africa are quite nervous at the best of times and possibly even quite skeptical at the best of times. So it's an interesting impasse up to the actual election.
We keep actually hearing about that, you know, SA Inc. is cheap as chips. And I'm wondering, Peter, you know, if this is maybe a good thing, first of all, you know, if we're accurately priced as SA Inc., if we're deeply undervalued, and what might, you know, be the factor that turns the tide for us, if at all.
So I think there's been a gradual outflow of money from the SA market. I mean, it's something we shouldn't ignore. Pension funds over the course of the last 2 years have been allowed to go from 25% offshore to 45%. So that's seen all the money drained out of the SA market and no new net buyers. You know, the guys have been net sellers. So that is probably kind of reaching an end, which is a positive and might, you know, randomly be at the same time when there's good SA news. We've also had low SA economic growth has just resulted in people not being interested in SA Inc. shares, valuations in some cases at crazy values. You know, there's a 10% dividend yield on a company like Absa, 5p multiple. And what will turn the corner is people, you know, confidence that there's sanity in place for the next 12 months. Very interesting to see if the lights go off after the elections. But you know, companies on a year-on-year basis, I think are in a better place than they were a year ago. So we would expect you can see a big bounce in some SA shares if the SA outcome is reasonable.
Actually, Mark, you penned an article for Financial Mail, I think last week, Thursday, and you said that sensible investment logic should prevail. I'm very keen to find out what this might look like during this time, specifically because we are 2 weeks away from this election, but it's really what happens afterwards that matters the most.
Yeah, so I don't think people should go strapping Kruger Rands to belts around their body and things like that. But you know, I mean, obviously, companies with good track records, good margins, so a bit of safety there, solid reassuring cash flows over a long period of time, and good management, just the sensible stuff. I mean, a lot of these shares are I think, remarkably cheap for considering track records. And if you look at these, I'm not so sure, even with a slightly bad outcome on the election, that they can actually possibly go down any further. If they do, you'll certainly get your money back in dividends to make up for that.
While speaking about...
I don't think...
Please go ahead, Peter.
I was going to say, you don't need to be buying small speculative shares on this theme. You actually want to buy, if the outcome is positive and foreign investors are going to come in and and be buyers for the first time in a while in our market, they're going to buy the big bellwether shares that they know and ones that are liquid. Liquidity is very important and size is important. So if you want to take a bet on a reasonable investment election outcome and get some market exposure, ironically, you go and buy the big boring SA shares.
I actually want to get into a stock snippet, but before then, I also want to speak about what to make of the fact that even though foreign investors at this point aren't, running in to buy SA stocks, they are looking at SA companies, and I think, the multi-choice deal comes to mind and a few others here that even though, buying our stocks and, keeping them on their books in that way is not what they're looking for. They are still on the prowl for a good quality South African entity. How do we make sense of that behavior, Peter?
So I think the businesses, SA businesses are generally worth a lot more than their share prices. So that often leads to two outcomes: the company itself buying back shares, a delisting, which is buying back a lot of its shares, or somebody from the outside coming in and buying. So you saw a massive number of delistings if you go back over the last 3 years. That slowed down markedly over the course of the last 6 to 8 months because interest rates are so high. At our business, we were listed. We thought we were trading at a crazy cheap price, so we bought back our shares and delisted. That was when rates were 8.75%. Rates are now 11.75%. So we wouldn't have done that now. It would be too expensive to borrow the money and do it. So I think high interest rates have stopped the delisting trend. But what it hasn't stopped is outside investors with their own cash who probably don't need to borrow money coming and making bids for SA companies. So I think all of this is a strong indication of the value that sits in SA businesses. And you've got some great quality businesses with great management, as Mark says. And either that trend will carry on, or the share prices will get up to levels where they become more fairly valued.
Mark, before we get into the stocks, growth stocks versus value stocks, is this something worth thinking about at this time?
Yeah, look, I think Peter's right. I think if foreigners do come in, it's not going to. I don't think they're going to look necessarily for deep value. That's my inclination always, but I've been like that for my life, I suppose. Yeah, they get the Clixes, the bigger companies, the companies that have performed well, they'll be picked up first, absolutely. So I think they'll be the first to lift off. Hopefully that tide will just wash the others up as well and bring them and buoy them as well as things move along.
With that said, I'm keen to get into some of your stocks at this time. Peter, maybe we'll start with you. I do believe that you sent some through here. If you are a retail investor sitting at home, what stocks are you most curious about during this period?
Yeah, so I think, there's obviously, this isn't our selection of top shares, but it's just the shares that are exposed to South Africa Incorporated. And we went for, you definitely want to be in the financial services space. Our banks are very cheap. So APSA at a 5p multiple and 10% dividend yield. We think that can still have the same compound growth as many others, as many of the other banks. Then Bidvest is your kind of classic SA industrial share, not dirt cheap, but very cheap relative to its history. And we put in Growth Point. I think to choose a property share, it's the highest, probably the highest quality local listed kind of bellwether property share. There you're getting a dividend yield of close to 11%. And post this year's earnings decline, as interest rates come down, you can probably get a 5 to 10% compound growth for the next few years after that. So, you're earning a similar, you put your money in the bank, you're going to earn 8%. Yeah, you get a 11% dividend yield and it's growing at 10%.
Brilliant. Mark, which counters are you loving at this time as well?
The one I suppose I like is HCI. I've written about it quite a bit in the recent years, and I see the share price sparked a little bit. I think there was a note put out by one of the boutique asset managers called Active about possible action at HCI. I mean, I'm not sure it would happen immediately, but the steps are certainly taking place. I mean, the big big bugbear at HEI is debt. They've got a lot of debt at the centre, and nothing really can happen until that debt's settled. But things are moving afoot. They got a big dividend from their bus company, Frontier. There's a big farm out payout coming from their impact oil deal with on the Namibian coast, and then hoping Sogo Sun will follow Sun International's lead and pay a nice big dividend as well. And that could really, maybe if E-Media, the broadcast company, also pays a decent dividend, we could see HEI's debt reduced markedly. I mean, seriously reduced to kind of maybe 500, 600 million rand, and things could start happening. I mean, I'm not really sure that holding all the listed companies inside HEI always helps. The liquidity is horrible in some of the smaller ones like E-Media and even Frontier. I think unbundling those could be a good plan. Maybe leave HCI with some of its growth assets, in the oil exploration and gas exploration. They're in the lotto business and also the platinum mining. So it could be a game changer there. And I think a fair bit of value can get unlocked. I think it's trading at a substantial discount to what the fair value is. I hope the active asset manager right, it happens sooner rather than later, because I am a shareholder there. But it has taken a while, and I don't think Johnny Copeland, the CEO, is going to be rushed into anything, but probably good value at this point.
Thank you for that, Mark. I also want to speak then about when we're looking at SA Incap bonds. SA bonds, Peter, just getting your overall thoughts on that one as well, and looking at some of those yields. And if maybe, investors might be looking at SA bonds versus equities also in this higher for longer interest rate environment, what does that do to SA bonds?
So you can get about 12% on SA bonds at the moment.
Sure.
If you can, I think a good way to think about that is on a similar duration 10-year bond in America, you're getting 4.5%. So you're getting 7.5% more in rand terms, and that's pricing in, that's kind of at the top end of where you've been. Inflation is stable. It's a real return in South Africa of 7%, which is what you would aim for with a very risky investment. Bonds are not a risky investment from a long-term holding perspective, as the government, we don't see the SA government not being able to pay you back. Mm-hmm. So it's pricing in a lot of risk. As interest rates globally come down, it becomes more and more attractive. So again, if the election outcome is reasonable and SA is, just doesn't deteriorate, you probably get a capital profit on top of that 12%. So in a rosy scenario, it's a 12 plus 8, it's a 20% return asset. If things turn out very well, we're very cautious on SA. We're certainly not banging the drum saying that everything is going to be all right. But it's if things are just a little bit better rather than a little bit worse, bonds look like an attractive alternative as well.
Mark, Peter just mentioned things a little bit better. Load shedding. I think we're at day 44 or 45 without load shedding. I'm wondering that dynamic here, if we see that going into elections and post-elections, does that do a lot for our equities, our bonds, but even just our story as an investment destination?
Look, certainly in terms of let's just talk about companies. You've seen in every set of results genuine impact from load shedding. I mean, you've seen huge costs being incurred, change in operational strategies, having to bring in alternative energy. So just from that point of view, look, let's not forget days lost for retailers, days lost for, I think the CAP, their mattress business suffered a hell of a lot in, from load shedding. So I think if this is more permanent, and I'm touching wood, it's going to have a meaningful impact on those income statements and on those businesses. So it is a good thing. And I have no reason to not believe what the Eskom guys are saying, that it's not burning diesel. I'm quite hopeful. It will be very, very meaningful, I think.
And before I let you go, Peter, I just want to get your thoughts then on certain themes we are seeing around SA Inc. Stocks. One of them, or maybe SA listed stocks, one of them is restructure. Another one is a few new kids on the block. I think We Buy Cars comes to mind, and a few others that we're expected to come later on in the year. Is this something that retail investors could be sitting at home just anticipating, considering the outcome of the election, of course?
So are you talking about new listings?
Yes, new listings, absolutely new listings. Looking at We Buy Cars as a new kid on the block, but even those that we are expecting maybe this year.
Yeah, we don't have visibility of new listings coming through during the course of the year. There always are some that are a bit of a surprise. But if you think about We Buy Cars, it didn't choose to list. It was almost a forced listing as a result of the mess that happened at Transaction Capital. So certainly the level of interest rates, the economic growth, and the woes that we've had in South Africa are not conducive to a buoyant listing market. So that's not a place that we think people are going to make money. But if we put on our rose-tinted spectacles, if there's a good election result and load shedding stays, there's always good quality businesses growing, in any economic conditions. So there would be companies that would have an appetite to list, but very few people are going to list when valuations are so low. One of the key reasons you'd come to the market is you can achieve a valuation which at least values you fairly. When there's a listings boom is when investors, there's a buoyant appetite, and investors are prepared to pay a higher value than companies would trade in the private market, which certainly isn't the case.
Mark, we often speak of value unlock. Any new kids you're hoping to see on the block there, emerging from a forced listing or anything of the sort?
Look, there are a lot of potential delistings on the cards. I mean, there's so many I could mention. Yes, but I mean, there are value unlock opportunities, certainly. I mean, just in the investment companies, I think some of them are being forced to do it. I know EP Capital said they need to unlock value and they want to do it. I'm not so sure about Remgro. I think that's more of a slow train. Companies like Brimstone, where it's just been dead money for a long time, but they've got one great asset in Oceania, and maybe a lesser one, so in Sea Harvest, potential there to kill their debt, release value, do some corporate activity, perhaps merge the businesses. Yes, there are a few things around. I'm sure, as I said, a good election outcome might hasten such decisions and maybe see some activity on the JSE.
Brilliant. It's all we have time for today, gentlemen. Thank you so much for your time, and I hope we've given our retail investors some things to think about this afternoon. Thank you so much. That was Peter Armitage from Anchor Capital and Marc Hasenfuss, the editor for Financial Mail.